Gold and silver just flash to signal the headline price can't fully explain, and the most credible Soguter voices in the system are already trying to wave it off as noise, because the spread is telling a story of the spot. Chart Kineti hide, and in a minute I am going to give you the one checklist that matters into the next delivery window, the two levels that decide whether this is a reload or a squeeze, and the exact kind of volatility trap that designed to make you sell the right thing at the wrong time. Here's what's happening in plain English. Over the last handful of sessions, precious metals have acted like a market that wants higher prices, even while it's doing everything it can to punish anyone who chases late. Big pushes, sharp snapbacks, strong closes, ugly intraday wicks. That's not random. That's the market testing your conviction and, more importantly, testing the plumbing. And that's where the real pressure starts. Because the easiest, laziest narrative will always be safe haven buying. The world feels shaky, people buy gold, end of story. But that story doesn't tell you why the microstructure starts squealing at the same time. It doesn't tell you why, in the background, you can get a situation where the headline price looks like it's stalling, while the cost to actually source metal, move metal, and finance metal starts tightening. And when that happens, you don't want to be the person staring at a single candle on a chart, deciding you're a genius or an idiot based on the next 10 minutes. You want to be the person who sees what the market is forcing participants to do. Because forced behavior is the only honest indicator in finance, but that's not the part that matters yet. The part that matters is the hidden detail most people skip right over. The physical market can shout even when paper tries to whisper. And it often shouts in a way the average investor never checks. Regional premiums, availability, delivery terms, the quiet extra someone is willing to pay to get metal now instead of later. Those premiums aren't a conspiracy. They're a consequence. They're the market's way of saying, I don't care what the screen says, I care what it costs to settle reality. And when those signals start to show up, they don't always show up evenly. One region can be tight while another is soft. One channel can be strained while another looks normal. That doesn't make the signal weaker. It makes it more diagnostic, because it tells you where the stress is concentrated. And if you're paying attention, it tells you what kind of move you're dealing with, an emotional spike or a structural squeeze. Because if this one level breaks, the math changes. Let Wes talk about what paper versus physical actually means without turning this into a lecture. Futures and spot screens give you a reference price. That reference price is massively useful, massively liquid, and massively influenced by hedging, leverage, and positioning. That's not sinister. That's just how financial markets work. But physical demand is messy. It's not just, I want gold. It's, I want this form in this location at this time, with this settlement term, with this bar list, through this dealer, in this regulatory environment. That now is why physical stress doesn't always punch you in the face through spot price immediately. It leaks. It leaks through spreads. It leaks through the curve. It leaks through what people will pay to bypass delays. And when you see those leaks start to widen while the mainstream is still debating whether the latest pullback from approved gold is over, you're watching a market that's tightening beneath the surface. And that's where the real setup begins. Here's the cleanest way to catch that tightening. Stop obsessing over the headline price for a second and look at how the market is pricing time. The futures curve, near month versus later month pricing, is basically the market's heartbeat. In a normal, well-supplied market, you expect a gentle upward slope as you go further out in time because storage, insurance, and financing aren't free. That's contango. It's boring. It's normal. It's we have enough. But when the market wants the metal now, when immediacy is more valuable than time, that curve can flatten or even invert. That's backwardation. And backwardation isn't a magical prophecy. It's a price signal that says, immediate availability is tight enough that I'll pay up to have it now. It can be temporary, it can be localized, but when it shows up repeatedly or when it shows up alongside other symptoms, premiums, inventory category shifts, delivery tightness, it stops being a curiosity and starts being a loud signal. And the mainstream almost never talks about it because it's not as clickable as gold rips. But it's more important than the rip, because the rip can be emotion, the curve is usually math. And this move isn't emotion, it's math. Now let's build the simplest arbitrage map you've ever seen, because this is where you start thinking like the desks that actually move price discovery. If one region is paying a premium for physical gold or silver, meaning the real delivered stuff is trading above the reference price, there's an incentive for metal to flow there. Traders, refiners, and banks try to buy where it's cheaper and sell where it's dearer. That's not manipulation, that's arbitrage. And arbitrage is supposed to smooth things out, except it can't always do it instantly. Why? Because metal is not a meme coin. It has forms, it has standards, it has refineries, it has shipping, insurance, customs, and settlement. It has lead times. If the premium shows up today, you can't teleport supply tomorrow. You can try to hedge it. You can try to lease it. You can try to swap it. You can try to source it from inventory that already exists in the right form in the right place. But if that inventory isn't T there, or if it S there but not mobilized, you get a lag. And in that lag, the spread is screaming. And that's why the price is lying frame matters. Not because the headline price is fake, but because the headline price can lag the physical constraint. The spread tells you where the constraint is. Now zoom in on the part retail investors almost always misunderstand. Inventory. People hear there are warehouses, and they assume inventory is inventory. But in commodities, the category matters more than the total. You can have a big number on paper that represents metal sitting somewhere, and still have a tight market where the deliverable portion, the metal that can actually be used to satisfy a contract under the relevant rules and time frames, shrinks on the margin. And markets don't break because the total goes to zero. They break because the marginal unit becomes scarce at the wrong moment. That is the difference between a calm market and a market that starts to panic inside the plumbing. In the futures world, especially for precious metals, you will not often see distinctions that amount to deliverable now versus not deliverable unless someone chooses to make it deliverable. The names vary by venue and by reporting style, but the concept is constant. When the deliverable bucket tightens into a delivery window, the market gets sensitive. Spreads can jump. The curve can kink. Shorts who assumed they could roll forever suddenly care about settlement terms. Longs who assumed they'd never need delivery suddenly realize they might want optionality. And market makers who live off smooth order flow suddenly face lumpy reality. But that's not the part that matters most yet. The part that matters is the calendar, because the market doesn't tighten in a vacuum. It tightens into deadlines, and deadlines create forced behavior. There are a few times when precious metals stop being a trade and start being a process. Option expiries can change hedging flows. Delivery windows can change settlement behavior. Month end and quarter end can change how funds mark risk and how dealers allocate balance sheet. Even thin liquidity around weekends can matter when the market is perched near key levels. This is why you all sometimes see metals behave like they repossessed. The same price level gets defended, attacked, because different players have different clocks. A macro fund might be thinking in months. A market maker might be thinking in hours. A refiner might be thinking in weeks. An industrial buyer might be thinking in quarters. And when those clocks collide, you get violent candles that aren't random. They're the market reconciling conflicting deadlines. And if you only watch headlines, you miss the reason the tape is acting weird. But if you watch the mechanism, you see what the market is forcing participants to do. Here's where the institutional behavior just turn loud angle comes in. Big money doesn't announce itself. It leaks through positioning and hedges. One of the quiet tells in metals is when you see price hold up even as volatility spikes, because it suggests dips are being absorbed rather than cascaded. Another tell is when you see sharp pullbacks that don't produce follow-through, meaning sellers show up, slam price, but can't keep it down. That often happens when someone bigger is using liquidity pockets to accumulate or rebalance, or when short sellers are covering into weakness because they don't want to risk a gap. And yes, gaps matter in metals more than people admit, because when liquidity thins, the market can jump levels. And the next detail is what flips the whole setup. Silver. Silver is the chaos agent here. Silver is not just a precious metal. It's a monetary metal with an industrial spine. It moves like a hybrid. It can underperform for ages and then suddenly sprint because its market is smaller, its positioning can get lopsided, and its supply is weird. A lot of silver supply comes as a byproduct of mining other metals. That means the supply response to higher silver prices can be delayed or muted. You don't have to just wake up and crank a silver mine the way you imagine in your head. Often, silver production is tied to the economics of copper, lead, zinc, and other base metals. So even if silver demand perks up, the pipeline doesn't instantly flood. Meanwhile, demand can be jumpy. Industrial procurement can come in waves. Investment demand can spike when gold moves and silver starts to catch up. And because silver is smaller, the same incremental flow can shove price harder. That's why silver can look asleep and then look unhinged. And that's also why silver can be the loudest confirmation that something structural is happening. Because if gold is moving for macro reasons and silver refuses to participate, the signal can be weaker. But when silver starts to behave, when it starts to break levels, reclaim them, and force shorts to respect it, you're watching something bigger than a headline. You're watching reflexivity, and that's where the real pressure starts. Now let's be brutally honest about macro, because people love to talk macro like it's a vibe. Precious metals don't move because people are scared. They move because the cost of holding risk changes, the credibility of currency regimes gets questioned, and the incentives to hold something without counterparty risk become more attractive. Real rates matter, inflation expectations matter, the dollar's strength or weakness matters, but the transmission mechanism is what matters most. collateral behavior, funding conditions, and the willingness of big institutions to hold assets that don't rely on someone else as promise. When the market starts to sniff that policy is boxed in, when tightening risks breaking something, but easing risks stoking inflation, you get a regime where gold behaves less like a trade and more like an insurance asset. Not because everyone suddenly became poetic about history, but because risk managers do math. And that math changes when volatility rises and correlation structures wobble. And yes, geopolitics can intensify that. Trade frictions, sanctions regimes, and reserve management decisions can all change how countries and institutions think about gold. But I'm not here to sell you a cinematic story about shadowy rooms. I'm here to point out incentives. When trust in the smooth function of global settlement gets questioned, even slightly, the demand for neutral collateral rises. And gold is the oldest neutral collateral on Earth. But here's the trick. That demand doesn't always show up as a clean, straight line up in spot price. Sometimes it shows up as steady underlying bids, as physical premiums, as reserve behavior, as quiet accumulation. And then it shows up as a breakout when the technical structure finally gives way. And once it breaks, the market can't unsee it. But that's not the part that matters. The part that matters is what happens next in the next week or two, because that's where people get emotionally wrecked. Markets love to take a real trend and dress it up in noise. They'll whip you around violently even if the thesis is correct. They'll scare you out with a sudden flush, then rip without you. Or they'll bait you in with a euphoric spike, then slam it just enough to make you question everything. This is the volatility trap. It's not personal, it's structural. Liquidity is a weapon. And if you don't have a process, your emotions will become someone else's exit liquidity. So here's your psychology shield. Separate trend signal from noise. Trend signal is structure. Higher highs and higher lows on meaningful timeframes. Support zones holding on closes, spreads and curves confirming underlying tightness, and dips getting bought in a way that doesn't collapse the setup. Noise is the intraday drama designed to shake positioning. If you can't tell which is which, you will always be late. You'll buy the top and sell the bottom and then blame manipulation, when the real issue was that you were trading your feelings, and that's where the real pressure starts. Now let's get concrete without pretending we have magical precision. In a move like this, the most important levels aren't one exact number. They're zones. There's the breakout zone, the area price pushed through that changed the character of the chart. There's the first retest zone, the place the market should defend if this is real. And there's the failure zone, the place that, if lost on a meaningful close, tells you the move likely needs more time or was a false start. In gold, that often means watching whether the market can hold above the prior major breakout shelf and whether pullbacks get contained above the last clean swing low that preceded the breakout. In silver, it often means watching whether it can hold above a reclaimed round number region and whether it can avoid slipping back into the prior range that trapped it for months. You don't need to pretend you can nail it to the dollar. You need to identify the battlefield. Because if this one level breaks, the math changes. And now the calendar trigger, because this is the why now that makes the next couple weeks matter more than a generic long-term bull case. We're moving through a window where liquidity can thin and deadlines stack. Option cycles matter because dealers hedge. When a lot of options are clustered near a level, market makers can become forced buyers or sellers as price moves, delta hedging. If price rises into a region where dealers are short gamma, they may have to buy as price goes up and sell as price goes down, amplifying moves. That's reflexivity. It can turn a normal trend into a squeeze. It can also turn a normal pullback into a flush. The point isn't to worship options Greeks. The point is to understand that sometimes the market isn't choosing volatility. It's being mechanically forced into volatility by hedging. Layer on delivery windows and balance sheet constraints around calendar closes, and you get a setup where small imbalances can punch above their weight. That's why you can see sharp moves on days that shouldn't matter. It's not mystical, it's mechanical. But that's not the part that matters most yet. The part that matters most is the proof stack, because one argument is never enough in markets. You want multiple layers pointing in the same direction. Here are the layers you should be thinking about. First, chart structure. Are we breaking out of multi-month ranges, reclaiming key levels and holding them on closes? Second, term structure. Is the curve flattening or inverting in the front end, suggesting near-term tightness? Third, inventory behavior. Not just totals, but category shifts and drawdowns that indicate mobilization of deliverable supply. Fourth, physical symptoms. Premiums, dealer tightness, delivery delays, regional demand differences that show real-world pull. Fifth, institutional behavior. Do dips get absorbed? Do rallies stick? Do flows seem steady? And does volatility rise without collapsing price? Sixth, cross-market confirmation. Are other metals or related risk signals hinting at broader inflation, supply chain, or geopolitical stress? You don't need all six to be screaming at once, but the more you have, the stronger the case. And right now, the reason this title is a market wake-up call is that we are getting multiple layers lining up in a way that makes it hard to dismiss as a one-day headline. But here's the credibility move. We must talk counterpoints, because this is where most hype videos fail. They act like metals only go up. Reality is uglier. Demand can slump suddenly, especially in price-sensitive jewelry markets. Policy surprises can strengthen the dollar and hit commodities broadly. Risk-off panics can trigger liquidity grabs where everything sells, even safe havens, because people need cash. Physical premiums can compress if supply catches up or if local demand cools. And term structure can normalize. If you see the curve relax, premiums fade, and price lose its breakout shelf on meaningful closes, you don't rationalize, you update. That's not weakness, that's how you survive. And that's where the real pressure starts, because survival is about process, not conviction theater. So what comes next, specifically over the next week or two? You're watching for one of two scenarios. Scenario 1 is the controlled pullback and retest. Price cools off. It revisits the breakout zone. Volatility stays elevated, but the pullback is contained. Dips find buyers. Spreads and premiums don't collapse. The curve doesn't suddenly steepen into comfortable contango at the front end. In this scenario, the market is basically shaking out late longs and reloading. It looks boring on the daily chart, but feels stressful in real time. That's the point. The market wants you to quit, and then, if the thesis is correct, it resumes higher with better structure, and the breakout becomes support. Scenario 2 is the continuation squeeze. Price doesn't give you the polite retest. It consolidates shallow, holds elevated, and then pushes through the most obvious resistance again, often during thin liquidity, overnight sessions, post-data jolts, or around option-related pinpoints. In that scenario, you get gap risk, you get air pockets, you get the kind of move where people wake up and the market is already through the level they plan to buy. And that's why risk management matters more than your opinion. Because even if you're right, the path can be violent. You can get whipped out on noise if your positioning is fragile. You can also get seduced into chasing if your ego is driving. So here's the near-term roadmap in one simple idea. Watch the battlefield zone, watch the curve, watch physical symptoms, and watch whether dips are absorbed or cascaded. If price holds above the breakout shelf and the underlying signals stay firm, the thesis strengthens. If price loses the shelf on meaningful closes and the underlying signals relax, the thesis weakens. If price breaks above the recent peak and the curve stays tight while physical symptoms remain elevated, the continuation squeeze risk rises. And if that one level breaks, the math changes. Now, let's talk about the one metric people must watch, because it really is the simplest forward a hidden detail check that keeps you honest without drowning in data. The relationship between physical availability signals and paper price behavior. You don't have to have perfect numbers. You just need to observe directionally. Are premiums, delivery times, and curve tightness confirming the move, or are they fading as price rises? Confirmation means the move has a foundation. Fading means the move is more likely to be purely financial and therefore more vulnerable to reversals. That doesn't mean it can't run. It means it can run and then snap back harder. And that's where the real pressure starts. Let me add one more layer that people underestimate. Volatility itself will be used against you. If you're new to metals, you might think you can trade them like a tech stock, but you can't. Metals have a unique ability to move in a way that feels insulting. They'll grind, then spike, then dump, then grind again. The point is to make you doubt the signal and act impulsively. The best defense is to define in advance what matters and what doesn't. A one-day flush that holds the breakout shelf can be noise. A multi-day failure that loses it and can't reclaim it is information. A spike that holds above resistance into a close is information. A spike that reverses and leaves a big wick while spreads relax is warning. Your job is not to predict. Your job is to respond to confirmation and invalidation. And that's why, near the end here, I'm going to give you the checklist again in the most practical way possible, because this is what people who actually keep money do. First, identify your time frame. If you're a swing macro watcher, you care about weekly closes and major shelves. If you're a shorter-term trader, you care about the immediate retest zone and whether volatility is expanding or contracting around it. Second, define the levels that matter: the breakout shelf, the retest zone, and the failure zone. Third, monitor structure signals, curve behavior in the front end, any signs of inventory category tightening, and any persistent physical premium chatter in key regions. Fourth, watch positioning behavior indirectly. Do dips get bought quickly? Do rallies hold? Does the market feel heavy or springy? Fifth, keep the two-scenario lens, controlled retest versus continuation squeeze. Sixth, protect your psychology. Don't confuse a violent candle with a thesis break unless it violates your defined levels on meaningful closes. This is how you keep your brain from becoming a profit center for someone else. And now the subtle part. because this isn't a begging CTA, it mess a filter. If you are the kind of investor who wants more than headlines, who wants to understand the plumbing, the incentives, the forced behavior, then you're already in the right crowd, and you'll want to keep tracking this setup like a process, not like a prediction. Because the market is giving you a wake-up call, and precious metals are sending a loud signal, but it won't hand you a clean, comfortable entry with a bow on it. It will hand you volatility, doubt, and a series of moments where you feel late, right before it moves again. The people who win aren't the people with the loudest conviction. They're the people with the cleanest checklist. So into the next week or two, keep your eyes on the breakout shelf. Keep your eyes on whether the curve stays tight. Keep your eyes on physical availability signals. And keep your eyes on the character of pullbacks. If the market gives you the controlled retest and holds, that's a reload. If it refuses the retest and pushes through resistance with tight plumbing underneath, that's squeeze territory. And in both cases, remember the same rule. Price can whip around violently even if the thesis is correct. And your job is to stay rational when the tape tries to make you emotional. Because if you can do that, if you can stop reacting to noise and start tracking mechanism, you don't just watch the market, you understand it.